All right, so today we're going to take a deep dive into this really interesting concept called mean reversion trading.
Yeah.
We're going to be looking at a system that's outlined in the book Mean Reversion Trading Systems.
Okay.
And the author actually calls it naive.
Wow. Naive.
It's all about finding those moments when the market is kind of like maybe overreacting a little bit.
Right.
And then figuring out, well, how can we,
Capitalize on that.
Yeah, capitalize on that.
Yeah.
We're going to be focusing specifically on the SPY for this.
Oh, okay.
That's the S&P 500 ETF. And we're going to be looking at data from 1999 to 2012. So quite a bit of data to unpack there.
Yeah, yeah.
But before we jump into the nuts and bolts of this naive system, I think it's helpful to define what we mean by mean reversion.
Sure.
So
mean reversion is, well, at its core, it's the idea that prices, whether it's stock prices or, really anything, they have a tendency
back toward.
Yeah, they gravitate back towards kind of a historical average. Okay. Over time.
It's kind of like
A pendulum?
a pendulum swinging back and forth.
Yeah.
Eventually it returns back to that center point.
Right. And
Even if it gets pushed really far in one direction or the other.
Yeah, it's like a rubber band you stretch.
Yeah.
Like it always wants to kind of snap back to that
natural resting state.
That natural resting state.
Exactly.
Okay, so that's a pretty clear picture of what mean reversion is.
Yeah.
But how does this so-called naive system actually play into that?
Right. So the system itself is incredibly simple.
Okay.
And I think that's probably why the author calls it naive.
Right.
It's essentially buying the SPY.
Okay.
After it's had a certain sequence of down days.
Okay.
And then holding it for a predetermined amount of time or until a certain profit target is hit.
So basically betting that, you're betting on that bounce back.
Yeah, after a few down days, it's probably going to bounce back.
Exactly.
But I guess the question is, how many down days?
Right. That's a key parameter.
Yeah. And for how long do you actually do it?
The study that we're looking at here, they specifically looked at buying.
Okay.
After just 3 consecutive down days.
Okay.
Holding for 7 days.
Okay.
And they aimed for a profit of 0.4%.
3 days? That seems like a pretty...
It's a short time frame, yeah.
Yeah, it's a pretty short time frame to make a decision on.
Right.
Wouldn't you want to see it like a longer downtrend?
You would think so?
Yeah, to really be sure that, it's not just like a random blip,
Make sure it's not just noise.
Yeah, it's not just noise.
Yeah, that's a natural inclination.
Right.
But the research is interesting because it suggests that even with this kind of naive approach, the system actually performed quite well. When they backtested it on SPY data, they actually found that it outperformed some trend following strategies.
Outperformed trend following.
Yeah.
That's really interesting because, you usually hear about riding the momentum.
Right. Buy high, sell higher, that kind of thing.
Yeah. Yeah, not kind of betting against it in a way.
Right. Kind of a contrarian approach.
Yeah,
I love that.
So what were the specific results like?
Okay. So get this.
Okay.
93% of the parameter combinations they tested ended up being profitable.
93%.
Yeah.
Wow.
They adjusted, the number of down days, the holding period, the profit target.
Okay.
And it seemed like almost every single variation worked.
That's a pretty compelling statistic.
It is.
But, you always have to be careful with historical data, right?
Absolutely.
Like something worked in the past.
It's not a guarantee for the future.
Yeah.
It's not a crystal ball, unfortunately.
Right.
So it's important to validate these findings.
Okay.
And there are techniques you can use for that, like walk forward testing.
Oh, okay.
Where you essentially test the system on data that it hasn't seen before.
Right. So it's like a more
realistic
Yeah.
picture of how it might actually perform.
Right. Okay.
You always have to be a little bit cautious.
Yeah.
Not get too carried away by the backtest results.
Right.
But it is definitely promising.
Okay, so this naive system sounds promising.
Right.
But further testing is definitely needed.
For sure.
Did they only test it on the SPY, though?
No, they didn't.
Or did they?
They actually applied it to a whole bunch of different
Okay.
ETFs and stocks.
Okay.
Highly liquid stocks. And the interesting thing is the results were pretty consistent.
Okay.
So it wasn't just...
It wasn't just a fluke with the SPY.
Yeah, it wasn't just like a SPY-specific thing. Right, exactly.
Okay.
It suggests that this kind of mean reversion approach,
right,
it might be applicable to a broader range of markets.
Yeah, it seems like there's like a broader principle at play here, but
there might be something deeper going on.
Yeah.
Yeah.
This whole mean reversion versus trend following thing.
Yeah.
It kind of makes you wonder, like, which one really comes out on top,
That's the $1 million question, isn't it?
Yeah.
So where it gets really interesting is that the author, he actually compared this naive system to what he calls an ideal trend-following system.
An ideal system.
Yeah.
So is that like a system that like knows the future or something?
Well, it's essentially a system that has perfect knowledge of future prices.
Okay.
So it's kind of a thought experiment, right?
Yeah, so it's like
saying, okay, if we could see into the future,
right,
and we knew exactly when a trend was going to start and end, how would that system perform?
Right.
It sounds almost unfair.
Right. A little bit.
Yeah.
But it's a useful benchmark.
I'm really curious to hear how this naive system stacked up against that.
Yeah, well, prepare to be surprised.
Okay.
Even with this cheating advantage, right? This ideal system that can see into the future, it only slightly outperformed the naive mean reversion system.
So you're saying that
a simple system based on mean reversion almost matched the performance of a system that knows the future.
That's pretty remarkable.
It is.
I mean, that really speaks to the potential power of this whole concept.
It's a reminder that mean reversion is a real force.
Yeah.
It's not just some, theoretical concept.
Yeah.
It actually plays out in the markets.
Even with perfect foresight, you might not have this huge advantage.
Right. Over a well-designed mean reversion system.
Exactly.
Wow, this is really making me rethink my approach.
It's thought-provoking.
Yeah, to trading.
For sure.
So this basic system seems to have, some real potential.
Yeah.
But is there anything we can do to...
That's the next question, right?
Yeah, refine it further,
So one technique that they explore in the book is called scaling in.
Scaling in, okay.
And that essentially involves taking multiple positions as the price continues to drop.
So instead of just buying like once after 3 down days, you might buy again if it drops for another day.
Exactly. You're kind of doubling down on your bet as it gets potentially more oversold.
Right. Which I can see how that...
It can amplify your gains.
Yeah. It also sounds like it also increases your risk.
It could increase your risk.
If you're wrong.
Yeah.
So there's a balance there.
There's a trade-off.
Yeah.
Yeah.
One thing the author emphasizes is that you should treat each entry point.
Right.
Whether it's after 3 days or 4 days or 5 or 6.
Each sequence
is
its own system.
Yeah. You treat each one as its own kind of system.
Exactly.
With its own characteristics and
its own unique potential.
Yeah.
So it's not just about blindly piling on as the price goes down. It's about
being more strategic.
Yeah. And selective about those entry points.
And here's an interesting observation from the research. The most extreme oversold conditions. Like, 6 consecutive down days.
You'd think that would be the best time to buy.
Right.
Right. They weren't always the most profitable entry points.
That's really counterintuitive.
It is.
You'd think that like the bigger the drop, the bigger the potential bounce back, Right. What might explain that, do you think?
Well, that's a great question and one that we can delve into further in the next part of our deep dive.
Okay, sounds good.
All right.
I'm really curious to hear what you have to say about that.
Yeah, we'll dig into it.
All right.
We'll unpack it.
So we were just talking about how those those extreme drops, the ones you think would be like prime for a mean reversion bounce, weren't always the most profitable entry points.
Yeah.
It's almost like you're waiting for that rubber band to snap back.
Right.
But sometimes it goes too far, you know?
Yeah, it highlights this idea that, you want to find that sweet spot where mean reversion is most likely to occur.
Right.
Buying at the absolute bottom isn't always the best approach.
Right. It's not just about buying when the price is low. It's about buying when the price is likely to revert back towards its average.
Right.
Yeah.
Okay, so before we go too far down that path, you mentioned this idea of scaling in, taking multiple positions as a price drops.
Yeah.
What were the results of that approach?
So when you allow for multiple positions, the profitability of the system actually increases significantly. The equity curve, which is, that visual representation of the system's performance, it shows this much steeper upward trajectory.
So scaling in really
it really amplifies the returns, which makes sense if each entry point is treated as its own system and they're all generally profitable. You're basically increasing your chances of catching that snapback effect.
Right.
But as always, we have to approach these findings with a little bit of caution, right?
Absolutely, always.
They're still dealing with historical data.
Right. Past performance is not necessarily indicative of future results.
Right. But it is fascinating to see the potential.
It is.
Of a simple rule-based system like this.
Right.
It really challenges this idea that, you need all these complex algorithms to make money in the market.
Yeah, it's a reminder that sometimes simple solutions can be surprisingly effective.
We talked earlier about how this naive system nearly matched the performance of this ideal trend-following system.
Yeah. Which is basically a fantasy system, right?
Yeah, it's like a fantasy system that knows the future.
Yeah, it's got perfect knowledge.
I mean, that was pretty mind-blowing to me.
It is.
But does this mean that we should all abandon trend following altogether?
No, not necessarily.
And just start buying every dip we see,
Right.
What are your thoughts on that?
So I think both trend following and mean reversion have their place.
Okay.
It depends on the market conditions. Your personal risk tolerance, your trading style.
Okay.
There's no one size fits all approach.
So it's not about
picking one over the other.
Yeah.
It's about understanding both and knowing when each one might be more appropriate.
It seems like the key takeaway here is that mean reversion
is powerful.
Yeah.
It's a powerful concept.
Right.
And it shouldn't be ignored.
Yeah. It can be a really valuable tool.
Absolutely.
Whether you're using it as your
primary strategy.
Yeah, primary strategy.
Or as a complement to other approaches.
Yeah. I'm starting to see mean reversion opportunities everywhere now.
Right.
But I know I need to temper my enthusiasm with
a little bit of caution.
Yeah, a little bit of caution.
Risk management.
Yeah.
Yeah. So
that's the right mindset.
Yeah. So we've defined mean reversion. We've explored this naive system.
Right.
We've seen its surprising effectiveness.
Yeah.
And even touched upon, scaling in.
Yeah.
It's a lot to process.
That is.
Where do we go from here?
That's a great question.
Yeah.
So in the final part of our deep dive, we're going to explore some of the broader implications of these findings and what they might mean for your own trading journey.
All right. Sounds good.
Yeah.
We've spent this deep dive kind of unpacking this whole naive mean reversion system and all this potential that it seems to have.
Yeah. And now I'm kind of curious, what does this all mean, on a larger scale?
Yeah, I think what's really fascinating about this is that it really challenges a lot of our assumptions about trading,
Okay.
It suggests that maybe we don't always need these overly complex strategies to find an edge.
Yeah, it's almost like complexity can sometimes be the enemy of execution, right?
Right.
The simplest strategies are often the most robust and the easiest to actually follow.
And this is, this naive system is really just a starting point.
Yeah.
We can build on this. We can refine it. We can adapt it to different market conditions.
So it's kind of like a framework.
It's a framework.
Yeah, for thinking about mean reversion. Not necessarily like a rigid set of rules.
Yeah, and that's where it gets exciting, right? Because you can start to think about all the different ways that you could potentially improve.
Okay.
Or expand upon this basic system.
So what are like some ways?
But one obvious avenue is to start incorporating additional indicators or filters to kind of fine-tune the entry signals.
Right.
Right.
Yeah.
So right now the system just relies on a sequence of down days.
Right.
But what if we also looked at things like volume or volatility, or even broader market sentiment?
Well, instead of just buying after 3 down days,
right?
You might look for some other.
You look for those confirming signals, to increase your odds of catching those really powerful reversals.
Right. Okay.
And then on the exit side, the book uses a fixed holding period and a profit target. But there are other approaches you could experiment with, like a trailing stop loss, for example, to
So you could
help you capture more upside,
right,
while also limiting your downside risk.
Okay, it feels like we've almost opened a door.
To like a whole world of endless possibilities.
Yeah, endless possibilities here. But if this concept is so powerful, like, why isn't everybody doing this?
That is the question, isn't it?
Yeah.
I think part of it might be psychological,
Okay.
Reversion really goes against the herd mentality.
Right.
It requires you to buy when everyone else is selling.
Yeah, that's...
Which can be really emotionally challenging.
It's that fear of missing out, right?
Yeah, the FOMO.
Yeah.
Everyone's chasing momentum.
Right.
And you're over here,
like,
swimming against the tide.
Yeah.
Patiently waiting for things to turn around.
Right. Okay, but isn't that part of what makes it interesting, though?
I think so.
Because, if everybody were doing it,
the edge would disappear.
It's almost like those contrarian strategies that produce those.
Often produce surprising results.
Yeah. So I think, this deep dive has been a great starting point. It's really just the beginning of your exploration into this.
The real learning comes from, taking these concepts and applying them to your own trading, experimenting, seeing what works for you.
All right. Well, I think we set out today to really understand this naive mean reversion system.
Yeah.
And I think we've done that.
I think so.
And more, we've learned that mean reversion is a really powerful force in the market.
Absolutely.
That even simple systems can be surprisingly effective.
Yeah.
And that there are endless possibilities.
It's endless possibilities
for refining and adapting these strategies.
Yeah, and I think that the key takeaway here is don't be afraid to challenge conventional wisdom.
Right.
Explore different approaches and always keep learning and adapting.
The market is constantly evolving. So
constantly evolving.
We should too, right?
We should too, yeah.
All right. Well, until next time, happy trading.
Happy trading.